Okay, so now we're moving on to our second topic, and this was actually when we set out the invitations for this webinar, we had a lot of questions about this. This is always one of our most popular topics. So investment strategy, portfolio construction, and diversification. So what is diversification? So it's building a diversified portfolio so you can reduce risk, smooth out returns, and improve long-term portfolio performance. And we often talk about this, right? And the ways to do this, investing across different asset classes, so equities, real estate, cash, gold, even different companies, sectors, and geographies. And I often refer back to this Morningstar chart. I think it's the checkerboard chart. This was a chart that was showed to me early on as well. And it really does a good job of showcasing what I just said. So basically, it shows all the different asset classes and how they've performed going back to 2002. And you can see how there's it changes all the time. And so the idea is you can see that, back in 21, it was Australian property that was the top performer. Before that, fixed interest, listed properties, small caps. Looks like this year might be commodities and cash. So no one can really predict what's going to be the top performer year over year. But by building a diversified portfolio, you can hope that, overall, like it said, it smooths out, and overall you do okay in the long term. So again, I always use that one because it does a good job of visualizing what we're talking about. And just a quick plug as well, Sharesight does have a basic diversity report if you're not aware of it. So you can get a little bit of this information from Sharesight. We have some default groupings. But as well, you can use custom groups as well with Sharesight. So this is my personal asset allocation. I created my own little groups, and I dragged and dropped my holdings into those buckets, and I get an idea of how I'm doing in real time, but I can always go back as well. And now we'll do another round of Q&A with our partners from this section. So we've got Laura from Diversiview, Anto from Stropro, and Mark from Morningstar. So my first question, I'll ask Laura and Mark. So I'll ask Laura first, and then Mark, if you can go after that. So I guess this is a question that I have personally that I've heard a lot about. So I've heard it's possible to be over-diversified. So can you explain how that can be and how to avoid it? Laura.
Hi, Angela, and everyone. To be honest, I think the word is a bit misleading. I don't think you can be over-diversified, but you can be misdiversified. So I'll explain a bit. What you actually want to do when you diversify is to reduce your risk of loss for a level of return which you expect from your portfolio. And now the portfolio return is a weighted average of individual investments returns, but the portfolio risk is much more complex than that. So you have individual investments risks, you have weights in your portfolio, and you also have this concept of correlations between investments. So how they move together in response to certain market events. So what you ideally do when you diversify is you look for good investments, which you want to get into, but you look for those good investments that are not correlated to each other or that are negatively correlated, which means they will move in opposite directions in response to different market events. So in that way, your total portfolio risk is lower than it would be if they were strongly correlated. So related to over-diversification, as I said, I think the best word would be mis-diversification, in a sense that people think that by increasing the number of investments, they are automatically more diversified. But when you increase your number of investments, you may get investments that are strongly correlated with what else you have in your portfolio already. So there is no magic number. The ideal is to look every time you want to make a new investment, look at the correlations between that new investment and what you already have in your portfolio, and figure out if that will improve or not your diversification. So you cannot say that if you have 12 or 15 or 20 stocks or securities, you are diversified. You may have all those 20 stocks very strongly correlated, which is not good. So I would say the secret is in doing your homework and every time putting a bit of time and effort to check on the real granular diversification, as I call it, at investment level. Many platforms will give you this high-level diversification perspective on asset classes and geographies. or other criteria. But I think you need to go a bit deeper and look at how they correlate to each other to figure out if the new investment is good for your portfolio. So it's not just return. You need to look at this correlation in order to reduce your risk as well, if you want.
That's very interesting. Thanks for that. Mark, what are your thoughts?
Yeah, I mean, I'd say overall, as an investor, obviously, what I am trying to do is I'm trying to get exposure to market risk, right? As investors, we exchange risk for reward. And so that risk that we talked about earlier, volatility, that's what I want as an investor. But of course, the question is, how do you go about that? And the issue is that every new security that you add to a portfolio comes with a cost. So there can be a straight up transaction cost, of course, that you're paying a broker. There's, of course, a buy-sell spread, bid-ask spread that you're paying as well for every investment. And as I add more investments to my portfolio, that, of course, is increasing my cost and making it look more like an index. So the point is, why would I could go out there and buy 199 ASX shares, or I could buy an ETF and get exposure to the ASX 200. So if I'm going to invest in individual shares, I need to think, okay, how many do I actually want to add to my portfolio before it becomes useless for me doing that? And we see this all the time with portfolio managers and funds where they are basically just creating a benchmark for you, charging you a higher fee for that, when you could go out and get that exposure through an ETF. So if I'm going to take on that security specific risk, I think I can go out there and pick individual shares that perform better than a benchmark, then I need exposure to those individual shares. So they need to be a meaningful part of my portfolio. And I can decide how much I want to diversify away that security specific risk. But if I take it all away, then I'm exposed to the market and I just have market risk, which is fine, but go buy an ETF, go buy something that replicates an index then.
That makes a lot of sense. Yeah, thanks for that. Okay, I have some homework to do. And the next question is for Anto and Mark. Another one that I keep reading about personally. So I keep reading mixed information about bonds and fixed interest.
So you're trying to deliver the highest return, I guess, at the lowest risk level. So to answer your question, Angela, I think the real question at the moment is that, interest rates have started to rise globally. We're seeing a lot of geopolitical tensions continue to escalate. And so investors at the moment, I would say, are very uncertain about what situation might eventuate. Most investors we ask that question to probably can't sort of nail a scenario in their head because they're competing with multiple different factors which sort of impact macro volatility, as you were describing before. And the way investors have traditionally responded from equity market sort of carnage that we've been seeing is they move down the risk curve into, I guess, bonds. However, with rapid interest rate hikes, by central banks, the value of those bonds obviously are at risk. And so you're seeing the largest, I guess, an end to a 4-decade bull market in the bond market, come to an end. So what do, I guess, investors need to consider when investing in bonds? They've had to think about the default risk. One is, what's the credit worthiness of the bond, right? Who are they actually underlying investment exposure linked to? They'll also have to think about whether they need to hold that bond to maturity. I think that's really important. Some people may not understand that risk. If you've got a Google bond that pays you 6%, and that was paying it a year ago when it was issued, and now interest rates are a lot higher, and Google decides to issue another round of bonds paying 7%, obviously the bonds that were paying 6% will be worth less in the market, right? And so if you bought that bond at $1 in market or $100, it's now probably worth $99, right? Or even less. So at that point, an investor has that risk of holding that bond to maturity, right? Which might be 5, 10, 20, 30 years. So that's really important. So credit worthiness of the issuer, holding a bond to maturity, and really understanding what the yield to maturity on a bond might be. It's really important. And if the other thing is not to treat it as a cash substitute. I think in a lot of investor conversations, bonds are treated as a unique cash sort of investment for a lot of people. I think you need to be very wary of those types of risks when entering the market at this point.
Yeah, that's good advice. It's not just cash. It's a holding like anything else, I guess. So you have to do your homework. Yeah, that makes sense. Thanks for that. Mark, what are your thoughts on bonds?
Yeah. We've got this saying at Morningstar that we're about the investor and not the investment. And I think it's a pretty important distinction because it's really about you and what you're trying to accomplish. And, bonds, as we just heard, yeah, they lower the volatility in your portfolio. But I think you need to ask yourself, why? Is that something that you need as an investor? And a lot of investors do. So a lot of investors need that if they're approaching retirement, they're trying to eliminate sequencing risk, or they're in retirement, and lowering the volatility is really important. But a lot of younger investors shouldn't be concerned about volatility. They should be concerned about long-term returns because those are going to help them achieve their goals. So if you want to lower volatility in your portfolio, bonds are a tool to do that, but they're not the only tool. So you can lower volatility by holding cash. And the advantage of cash, and I know this is a little strange to say in an inflationary period, but the advantage of cash is that it's not going to go anywhere, right? So at the very least, obviously from an inflation perspective, it can lose value, but it's not going to go down like bonds, and bonds can go down significantly, which I think is underappreciated. You can also lower volatility by investing in certain types of shares. So large caps over small caps, investing in dividend paying shares versus non-dividend paying shares. You can invest in shares that are in quote unquote safer businesses where the expected future outcomes are less. So think a biotech company versus investing in a company like Coca-Cola. So there's lots of different ways to lower volatility. So if that is your goal, think about what tool is right for you. And then kind of one final thing that I'm hearing a lot is a lot of people think that a bond is a hedge for the share portion of their portfolio, that literally bond prices will move inversely to equities. And I think a lot of those people, obviously looking at what's happened this year, are realizing now that's not true, and historically has never been true. Because if we think about drivers of equity prices and bond prices, high interest rates generally aren't great for equities because they are going to lower the valuation that people will pay for them. And they're mathematically horrible for bonds, which is the situation that we just talked through. So yeah, I think it's just thinking about you, thinking about what you're trying to accomplish and focusing on you, not the investment.
That's all really good advice. Thank you. Yeah, I just think there's so much misconception out there. We get this question so much about bonds. I know I've been confused about it. So yeah, I think that's all really, really good advice. Thank you so much, guys. Just like, yeah, keep your own personal circumstance in mind and do your homework. And bonds are not cash, I think was the one that I think I wrote down for myself as well. It's not the same thing at all. Okay, so for a final question, I'll ask for all of you, and I'll start with Laura. What is the number one thing to keep in mind then when it comes to diversification?
I would say that there is no special recipe. Whatever makes sense for your particular portfolio, there is no, I don't really believe in the 60-40, 70-30 or 100 minus age sort of approaches. It really depends on what you have in your portfolio, how, what's their expected returns, what's their risk, and how you combine. Like Mark said, it's about you as an investor, and it's not about following what somebody else says. You need to do your homework again, coming back to the same theme, and calculate what brings you to your goal. So you have your goal, which you want to achieve. Either you are a young investor or a retirement, kind of close to retirement. Something else will make sense for you. And how you can combine your investments, it's again a problem. You need to calculate that and not just take specific kind of rigid approaches which other people say. So yeah, do your homework. Don't necessarily follow the trends.
Okay, thank you. Anto, number one thing to keep in mind for diversification?
Yes, sorry, I was on mute there. Usual problem. But yeah, look, Dr. Rusu makes a pretty good point. I think, and also Mark, it was a great point to make. I mean, I think investors should keep in mind that, the most important sort of metric not to look at is really what return you're achieving, but I guess how those returns are weighted against the risk that you're taking on, right? So that's really important for me. I also think what's really important to look at is how investors should be accessing strategies which are not correlated to the market, right? I'm a big believer in alternatives, and you guys probably saw that in sort of the platform we built, and not really to take away from, what we do, but it's really about focusing on alternatives, I think, that are not correlated with your overall portfolio. I think that can really provide optimized or risk-adjusted returns. So, you're not really reliant on a bear or a bull market to achieve a return. I think it's something that I commonly describe amongst investors. You can also actually access fixed returns over your portfolio without having to worry about where bond yields might be or interest rates are going. You can actually get greater certainty. And we like to use a thing called defined income investing or defined outcome investing. And that's something we do using some of the largest trading teams across the globe. So yeah, for investors, I think about using non-traditional asset classes. So not just property and equities, but explore a set of opportunities, whether that be in private credit, VC, private equity, hedge funds, things that are not necessarily correlated to the market can reduce your volatility considerably and achieve better risk outcomes for you.
Mark, any final thoughts on diversification?
Yeah, I mean, the only thing I'd add is, once again, like with everything that you're doing investing, like you want to be deliberate about what you're doing and you want to do it in a structured way. So I think a lot of people just have this notion that diversification is I'll just throw a bunch of things into the pot, and they're not doing it in a deliberate way. So it's thinking about, okay, if I add an asset, as Anto was saying, if I add alternative investments, why? What am I hoping to accomplish with this? What am I changing of my overall portfolio, and how does that align with my goals? But don't just throw a bunch of stuff in there. And, you can be very diversified by owning 2 ETFs. Right? You can own thousands and thousands of securities and be completely diversified. You could be someone who owns 10 ETFs. They're all investing in the same thing, right? Like a lot of the indexes now are large cap US tech dominated, right? So there's a lot of overlap between this. So just do things in a deliberate way, and think about what you're actually trying to accomplish with diversification and everything else, I guess.
That's the common theme that we've seen with all of your answers is do your homework. Don't just pick things willy-nilly just to diversify. Everything that you add to the pile does make a difference. The correlation that Laura mentioned, I think, is really interesting, which I know Diversiview kind of shows you visually, which is really cool. But yeah, everything that you add, I think those are really good takeaways. Don't just add stocks just for the sake of adding it. Think about how it relates to the rest of the portfolio and how that will work, and even the risk as well that you're willing to take on for that. So very helpful. I took a lot of notes. Thank you.